Again, if everyone's green light, I know that Jeff Silber had to go through his internal approval. And
Be okay.
Okay, we're recording.
Good.
So we'll give another 2 minutes for people to join a minute late. But again, I think we want to use our time efficiently. And my welcoming remarks are things that people enjoy missing anyway.
Now, they're the best part of the session.
They're the only consistent part of the session. Seth, do you have this on a TV screen above you? We keep seeing you looking up.
Oh, no, I just have a couple of monitors, and one is showing my portfolio, and I'm just, I just have a couple of monitors, and I wrote some notes, and so I have my notes sort of adjacent to what I'm going to ask you all.
Great.
So there's not a higher authority attending? I thought given this was YU, maybe.
I have one of these, standing desks.
I hear a hydraulic lift.
Yeah.
Also known as a forklift.
He's got the Coronis 19.
Yeah.
I was sort of hoping, Seth, you would have a row of bicycles behind you.
Oh, that's another room. We do have, if you want, you can see in a moment of vanity. If you see all these plaques,
Yes.
Yeah.
each one of them is a patent that I wrote.
Oh, wow.
That's great.
Which is why you're able to moderate this panel.
One of my great vanity projects. I don't have any sports trophies, but.
Now truly Jeff is sideways.
Just make sure your kids can't see them. It'll be too intimidating.
Let's try this again.
Here.
Sorry. Better? Okay.
Yes. Did you lock the?
I don't know what I did.
Looks like you locked the orientation of your.
All right. Well, this works now, so we're okay.
It's working, so let's do it.
Orange
Yeah.
102, the Yeshiva.
All right. So welcome, everybody. I think our attendees are just getting queued up. So this is our third YU Wall Street YU Technology event. Perhaps there have been others. Dina Burkett and Michal Kleiman from YU Alumni Affairs are actually joining us. You can see them on the screen here. Thank you for teeing these up. We obviously prefer to do these events in person, but obviously we've all been probably quite familiar with Zoom in our work lives and shuls and schools, and we're touching in different ways. Obviously, we hope that everyone is safe and sound, and pray that everyone continues to be well, and pray for those people who are not feeling well that they'll recover soon. And the YU Wall Street, YU Technology Group, these forums have been well received in person. We're trying to find out a little bit more whether it's for the content or for the networking. Maybe it's a little bit of both, and doing a little bit of comparison, maybe of seeing how these are adopted online will inform us a little bit about that as well. We had over 100 people register for today's event. A quarter of them were from Israel. And hopefully some of the people who are coming on board will pass this word around. Our goal is to do them every Wednesday around lunchtime. Right now we're working with 1 o'clock in New York. If people find that it's better to do it noon, that's a little bit more convenient for people dialing in from the UK or Israel or California, please let us know. But we've got a great panel today in light of the fact that those of us who have children are probably seeing them on Zoom quite a bit. This new world is really, I think, going to feature the idea of education technology. Education technology has existed for a long time. It's been ramping up. We have 5 experts in the field who have been an expert in the field before coronavirus. So obviously this has been a world that the field of education has been thinking about how do we use technology to enhance learning. And I think lay people are probably seeing it a lot more because they're just seeing their kids starting to interact a little bit more. So we were happy to have this one to be the next event. We appreciate the panelists for giving their time and their insights to the community today. Hopefully we have people from different schools around the world who are going to benefit from this education. I know YU has been doing a lot. And maybe we'll leave it to Seth Haberman to be the moderator here. Seth is actually now a two-time moderator. Seth moderated once before, maybe 3 years ago, for an Edtech panel when he was CEO of Visible World. Now he's the CEO of Sense Education, which I'm not going to do the disservice of describing it a little bit. Hopefully Seth will do that for us. So Seth, please, if you would take it away, and we'd love to learn more about Edtech.
So good afternoon, everyone. And it's actually nice. I think I met all of the panelists. I mean, I know Josh for many years, but I think we all met making Minion at the ASU GSV conference. And so it's nice to be back with you. And I'm sorry we can't make a Minion today, but it is nice to be back with all of you and the camaraderie. And I think, you know, we started having a little conversation yesterday, and I had to sort of stop it because I said, listen, leave this for the audience, because all of the people on the panel have incredible amount to say, and from a lot of different vantage points. And so I'm going to ask each of them just to give the briefest of introductions. And if you have an association with YU, you may want to mention it. So I'm going to start. Josh.
Sure. Thanks, Lawrence. Thanks, Seth. My name is Josh Schwartz. I'm a long-time M&A professional. I've been doing that my entire career. Started as a lawyer at Skadden Arps, went to Bear Stearns, and became a banker, and ultimately focused on media and entertainment in the late 90s. And it was then that I started getting interested in the education industry, which was in the very, very early days, years before it was dubbed Edtech, which is how it's referred to now. And I had, at that time, an interest in it for a couple of reasons. I thought it was a great opportunity to get into an industry early as it was forming. But I also felt like it was a unique opportunity to be a mercenary, as I was, you know, doing transactions, but actually work with clients that were involved in making the world better. So the double bottom line that people always talk about in the education industry was something that resonated with me. And over the last close to 20 years, have participated as this industry has grown up into a bona fide industry that attracts venture capital and private equity and has publicly traded companies and the like. And so it's been, for me, very great.
The word briefest is not necessarily
Briefest? Oh, I'm sorry. Brief is in the eye of the beholder. Anyway, so we've been involved in this sector for quite some time. And I founded a firm called Eastwind that one of the areas of specialty is education, and very active in Israel, both from the standpoint of launching a conference to increase awareness and also a new fund to invest in talent technologies. And I'm happy to know all of the panelists quite well as a result of being involved in this sector.
terrific.
Back to you, Seth.
Thank you. Judah.
I'll be the brieferest as I can be as well. I'm Judah Karkowski. I am the head of M&A and really all of inorganic growth at Cengage. Cengage predominantly services the college market through textbook and learning technology and courseware. It's about $1.5 billion business, and I oversee the process of figuring out where we grow, how we do this, not in the next 20 days, but truthfully in the next 2 to 3 years. And my role over the last 18 or so months has been focused on a merger with another large company. And through that, we've had to kind of change the the vision for how we attack the market and understand pre-COVID, what does the landscape for education look like, and spent quite a lot of time taking the pulse of subject matter experts around the world. And now with a COVID overlay, really understanding where I see the megatrends and where we see the opportunities in education. So I'm very excited to join today and be able to engage in conversation with the panelists and the audience.
And you're also a fireman, right?
I am a fire commissioner. I'm a paramedic. I live every 5-year-old's dream.
Harris.
Hey, so I'm Harris Goodman. I'm currently the Senior Vice President for Corporate Development and Strategy at an organization called Achieve 3000. Achieve 3000 is a K through 12 education company, Edtech, right, that we talk about, focused on literacy as well as math acceleration for our students. I started in education in about 2010 as a co-founder of a company called Late Night Labs, which focused on science education, primarily in higher ed, and have been tinkering around with kind of early stage and growth stage venture PE-backed education technology since then. A ways back, I was an alumni, actually I'm an alumni of Yeshiva University. I graduated in January 07, so it's always great to be connecting back with the group and the organization here at large with YU. So it's a pleasure to be joining everyone and looking forward to the dialogue ahead.
Perfect. Jeff?
That was brief, right? That was brief.
Cool. I should have had you go.
5 seconds longer than mine. Perfect.
There you go. So I'm, excuse me, I'm Jeff Silber. I'm a stock analyst with BMO Capital Markets. BMO stands for the Bank of Montreal, which is of course headquartered in Toronto, and I work in their New York office. I cover a wide variety of industries, but for today's discussion, you're probably most interested in my education coverage. We picked up the education sector, excuse me, last millennium, 1999. So before Edtech, I think you just did, covered a number of the school operators. And I typically focus on the publicly held companies. So these would be companies after Josh has helped them raise money. Hopefully they're successful and they go public and we'd be following them from there. My connection to YU, I'm a Yeshiva College grad, class of 1984. So those of you that are math majors on the phone can figure out how old I am.
Terrific. Thanks very much. Let's start. I'm going to very quickly, just for a minute, share a slide. I have a son. Can everyone see that slide?
Yep.
Okay.
Yep.
I have a son who goes to the University of Chicago, and when they shut their campus down, I think March 7th, which was among the last schools, very quickly on the Reddit boards of Chicago, this appeared, which was making fun of the fact that Chicago was going to become a streaming service. And for those, if there's anyone not on video, it says Netflix, $108 a year. Netflix spends about $13 billion a year in content. Hulu, $120 a year. Hulu spends about $2.3 billion in content. Spotify, $72 a year. They spend about $1.2 billion in content. And the University of Chicago streaming service, $57,642 a year. So I'm just going to start out with our panelists. The students who put this up, they were poking at something, and what do you think they were getting at? And do you think they have the right idea in framing education in this fashion? Harris, why don't you start us?
So I think it brings to light a question of, pricing to value and how you think about what you're going to be getting. But I also think it's eye-opening in the sense that it's raising the question that we always have, which is higher ed too expensive for us? And what is the value proposition and the investment, and will it pay out in the long term? We all know the kind of value we get from a license of Netflix, right? We all know the faudas and all the good shows that we get from it for pleasure purposes. But what I would argue, and I'm just playing devil's advocate here from my own personal kind of views, is that the impact of a higher education can and is supposed to, in theory, create a pivot point or a trajectory to elevate people, as we have been commonly told, to elevate us out of a socioeconomic rung that we're currently in and propel us into a different area. And so
Not to cut you off,
That's
you're arguing value as opposed to cost. Meaning, you're saying,
yeah.
like, it's worth 50 cents, it's worth 200 grand, no matter what it actually should cost.
Well, I think everything has a cap, right? And I think what we're kind of looking at now and we're thinking about is, have we really hit that cap? And if we're moving from a on-campus experience to a streaming service, which is what this is really focusing on here by putting it in light of these specific companies, then I think the value proposition and the pricing probably has to change, because the value, what is the true value and purpose of higher ed? Like we mentioned before, is it the networking on campus? Is it the content? What is it that's providing the value?
Judah.
Yeah, so I think that it's interesting, Seth, the way you're looking at it. I'd love for you to put it in the perspective of what does the entity spend on content. So what is Netflix's budget on content creation prior to dissemination? Because you use Chicago and Booth, and as you get even narrower, the audience that patronizes that streaming service is tiny as compared to the audience for Netflix, Hulu, and Spotify.
I think that's, I just interrupt. So Netflix spends $13 billion a year on content. And Chicago, the numbers I got, which is sort of infrastructure, buildings, and teachers, is about $270 million. But Netflix has, the big difference is not only they spend significantly more, but Chicago has 6,542 streamers right now, and Netflix has 167 million.
Yeah, so you get to spread that out. That's nice.
Yeah, so I would argue that in a streaming world, the issue with Chicago isn't the value that it gets. The issue is how many people subscribe to that particular service right now.
So interestingly, you said it was 13 billion and 165 million users?
167 million users at Netflix.
Close enough. So you're talking about $75 a user, if you amortize it equally over everyone, is kind of how their $13 billion of content works out. So arguably, we can they aren't profitable, but we can make the argument that somewhere in there is their total cost of investment. And Chicago has a similar structure in here, which should showcase that even if they're super wasteful, at the end of the day of watching Netflix, Harris goes back to the water cooler and is able to talk about Fauda. At the end of a 4-year degree in Chicago, you have a degree no one's ever going to take away from you.
Seth, can I chime in here? Yeah, I just want to say, I think people talk a lot about whether or not COVID is a paradigm change or just an accelerant. And I would say, a lot of the themes that we're talking about right now are really just accelerations of themes that have been going on for years. One of them, for sure, has been, what's the value of a degree? And the figures on this sheet are provocative and shocking, but I would argue, the ratio actually makes sense if you're comparing a degree from University of Chicago and the impact that could have over one's lifetime versus, watching an episode of Tiger King. But the reality is, and you touched on this, University of Chicago has to start wondering whether or not they can continue to charge $57,000 a year when you've got other forms of certificate granting institutions and even degree granting institutions able to do it much more cheaply and much quicker and deliver to employers what they want, which is a new employee or an existing employee who's got the skills that enable them to be productive, immediately.
You guys just put your financial hat on. Doesn't that look like somebody should disrupt Chicago? I mean, Jeff, right? If you look at those numbers, you say, geez, there's a business waiting to happen.
And there are plenty of businesses trying to do this. Let me just add one point to the previous conversation. In Chicago may be a bit of extreme, but I'll ask you, are you or your kids, are you willing to pay that kind of money just for the content? There's a lot more involved going, especially undergrad, beyond content. It's meeting and interacting with the professors. It's gaining lifelong connections. I've made lifelong connections from my time at YU I haven't done that on Netflix or Hulu yet. So I think that is one, reason why the price points are dramatically different. But, in terms of people disrupting, we've seen a lot of disruption more at the at the graduate level. Because the graduate level, yes, connections are important and the experience is important, but I think that's an area where people are more focused just on the content and getting the skills in order to expand their careers. And that's where we've seen companies, these OPMs, these online program management companies, et cetera, disrupting that market. I think this is an opportunity to see something similar, maybe not as extreme, in the undergraduate market.
So let me sort of continue in this, but in the context that Josh just put out. COVID has come, and I'm going to give you my quick paradigm that I tell investors when I'm raising money. And the paradigm was, I came from the entertainment industry before I was in Adtech, before I was in Edtech, and there was a evolution that entertainment started out live. It was opera, it was theater, and that means it was in a fixed place at a fixed time, one place only. And when movies came along, you still had fixed times and fixed locations, but you could have multiple performances of the same thing, and so you got more scale. When television came along, you still had fixed times, but it could be in the home, so that the number of locations expanded greatly. When you had things like cable and VOD and things like that, you got more choice, you got the what you wanted, and you got more times because you could have when you wanted it. And finally, internet, mobile gave the full what, when, where. And so that, and what we saw when we went through that evolution is that every time we took away an infrastructure barrier, you needed to own a local theater, or you needed to own a theater company or things like that, till we went to this zero cost distribution, the business kind of consolidated, and the bigger ones got bigger and bigger, right? That's the scenario that happened in the entertainment industry. If we remove physical infrastructure from teaching, if we say, COVID is going to accelerate this streaming version of education, what happens? Do we get giant education institutions? You guys, first of all, do you guys buy my story?
I'll start. I mean, we already have giant education institutions. You look at, Southern New Hampshire University. I think they've got 100,000 students. Arizona State. So that does exist.
Except those are yes and no, because when movies theaters came about, it was less than 10 years till you had tens of millions and then hundreds of millions of people seeing movies. And if you look at some of the education institutions in China, ours are tiny, right? New Oriental has 7 million students. Our largest public institution is ASU with 130,000.
Well, I argue part of the value drivers is the supply demand of the institutional degrees that we have. So when you think about University of Chicago, they're not thinking about scaling their client base, right? They're not thinking about scaling students on campus. They have a limited supply of space that they could provide. Now, going online and distance does provide that, but then they have to think about the exclusivity of that type of a degree and the caliber of person and metrics that they're looking for who can get into that institution. It's very different than an ASU, which actually wants that scale and is looking as a revenue model to drive growth, similar to a for-profit like a University of Phoenix previously tried.
So Seth, the very critical part is, are you familiar with MOOCs?
Yeah, no, but I just want to give an answer to Harris, and then I'd love to hear. So Harris, my answer to that is if you go to Europe, the greatest buildings ever built were the opera houses at the end of the 19th century. Because the only way they could scale what they did was to make opera houses fancier and bigger and things like that. But opera is the last time I checked, 0.1% of the entertainment industry budget. Yeah. And so my question is, isn't it inevitable that, as I think Judah's about to start to say, that MOOCs will take over and that people who are bound to infrastructure won't be able to keep up? Judah, I'm sorry for interrupting.
No, I think that your line it's logical in the vacuum. The reason that we ascribe a lot of value and why it still commands a lot of dollars is because there is, both to Harris's point and yours, that tug of war between, do I have something now that I otherwise wouldn't be able to get anywhere else, and it has that patina on it, like a Harvard or a U Chicago degree, that makes
or YU.
So I'm kind of buying my future. It's part of the whole UPhoenix, won't use the word scandal, the whole UPhoenix challenge, where they had spent a lot of time marketing. They didn't even care if people enrolled. It wasn't even about taking the classes. It was kind of about creating this all access pass that you would have had. And what we find is that it's growing too big, where you have so many students kind of partaking in a stage on the stage style, one instructor or two instructors for 600 faceless humans kind of sitting in the audience, just does not have that same piece. And someone on the chat said that they feel a disconnect, that they're not really getting what they're paying for. And it would be interesting to hear what the audience thinks they're paying for. And we should speak to what YU students specifically have said they're paying for. But to me, the all-encompassing experience of school, whether you agree that the price is related to value, I don't think it comes down, or makes sense to come down, to something that's made in your equivocation there of $100 so a year.
Okay, I'm trying to push, but let me ask you related to what you started to say, Judah, and I'm going to throw this at Josh. So I came from the Edtech business. Well, there were lots of successes. I mean, if you started me now, I could go on for half an hour, and the number of exits and hundreds of millions of dollars or $1 billion exits. And when I first came, when I told people I was going to go to Edtech, everyone sort of went like this, like what are you doing? You know,
including me.
Why don't Edtech companies, the combined size of the education market is larger than software and media and ad tech all put together, and defense, by the way. I think the larger markets are durable goods and housing worldwide. So there's $6 trillion or so spent in education. So why isn't Edtech, why aren't they great investments? And I know there's some exceptions, but why overall are these not great investments? What's the explanation for that?
Look, I think there are great investments, and every year we see more and more great investments, and that will continue. I mean, there are literally billions and billions of dollars being invested in EdTech now, up until obviously the coronavirus situation. That's not going to stop. Deals are still getting done. As we're sitting here, we see announcements, at least on the finance side, and that's up multiples from 5-10 years ago. But you're right.
Exits.
Yeah. Okay. Well, I mean, you need capital to grow companies to exit. So M&A volume up significantly as well. And when I first started in this industry, investors would say, we'll invest in higher ed, we'll invest in corporate. We wouldn't touch K-12 with a 10-foot pole. There's no interest. There are 14,000 school districts, over 100,000 schools. Every district makes it, it has a dysfunctional purchase structure in place. There's no way to scale a company. And in the last several years, there's been I would say about 5 consolidation plays in K-12, with exits in the hundreds of millions of dollars, if not billions of dollars. I think the difference between education and ad tech and media in some sense is it's hard to get escape velocity quickly, at least in the US market, because it's difficult to sell directly to consumers. And so you don't see things going like they do in China from 0 to $1 billion overnight. If it's a B2B model, and I'll say B2B actually has been embraced by investors, it takes a long time to build a sales force and to enable it to be effective, but it does happen. Higher ed, probably more rational sales cycles, but certainly not like selling into corporate. So there's some structural issues, but it doesn't mean that you can't get a great ROI on investment.
Yeah, I was going to say, I'd like to add to this, since this is sort of what I do for a living. So if we were doing this 12 years ago, and obviously we didn't have Zoom then, but back then, University of Phoenix was a publicly held company called the Apollo Group. I think it peaked at about a $15 billion market cap, if I remember correctly. We've had a lot of changes in the industry since then. And, you know, I know this is not a panel about the for-profit sector, but, you know, we had a lot of issues where there were new regulations, for-profits were accused of doing things they shouldn't do. Whatever happened, a lot of those investments soured. And even though maybe they weren't edtech companies per se, I think the overall impression from the public markets of investing in education went in the wrong direction. And we're moving away from that. And maybe COVID, you know, this whole experience will help that. But that's still kind of a cloud that hangs over the sector.
I'm going to give you a different, I'm going to give you a different, a counter reason. Not because of scandals, not because of structure and things like that. Why is advertising such a great business for entrepreneurial companies and disruptors to do? Because if you do well, your clients make more money. And the problem in the education market is if you educate people, yeah, your clients make more money, but they don't share any of that with you. Right? In other words, and it takes a long time for people to appreciate the difference. Right? So if I am that University of Chicago and I train some kid to graduate and he does well, I don't get any of that money as the educational institution. There's a misalignment with the value created. It goes back to what we started with between what is the cost of something and what is the value creation of something. And so that's going to bring another question that I have. That's my theory, because the businesses that grow fastest are the ones where the value that you create, the real value that you can create and be monetized is closest to the service that you give, right? That's where real value is created. So if I do something and then the people who buy that can make even more money, that's where that value comes in. And so my question is on this, which is, does education, especially in the United States, need a different payment model, right? If education, Harris, is as valuable as you say it is, shouldn't there be different models of how to pay for it? Should it be a public model? Should it be a shared risk? Like, do you think I'm crazy? Tell me what your sense about alignment is here.
It's a great question. There's a lot to unpack in a question like that because it ties into so many different markets. When you talk about debt, for instance, in our country, look at student loan debt and how much it's ballooning and how we're going to be servicing it and all the industry even tied to that. So there's a lot of inertia and there's a lot of complexity around the business of student loans and financing a career path through college and higher ed. It will be hard. You've found a number of companies over time that are trying to disrupt that through different approaches of saying, hey, we'll pay for your degree if you give us X percentage of X years of your work, almost like indentured servitude, right? Which almost seems like a step backwards, maybe you could argue. It's a complex question. I think you're not going to see a lot of disruption as relates to the specific model that you're discussing. I think where you'll see disruption now, especially impacted with the accelerant of COVID, is going to be in what you're seeing at schools like Southern New Hampshire University, which is you have one cost to be on campus and one cost and fee to be online. And that's where we go back to that pricing to value conversation again, which is what am I looking for in a college degree and what is the purpose of me going to college? And they're going to price to that type of model, I think, going forward.
And can I jump on?
So, yeah.
And say, Seth, there are inexpensive mechanisms of gaining knowledge and having skills-based or topic-based growth without having the degree. There are inexpensive degrees. You can go to a community college and pay thousands of dollars and get an associate's degree. You can go to a CUNY and you can pay thousands of dollars and get a bachelor's degree. No one's forcing you to pay $56,000 a year to go to University of Chicago. You're paying for some value that's beyond just the content. I got to imagine that someone that graduates with a degree in English Lit from U Chicago and someone that graduates with a degree in English Lit from Queens College, there might be some significant differences in the quality of the instruction or the quality of the materials used, but within reason, they've pursued a liberal arts degree, and one should argue that they either got their value or didn't get their value. My response to you would be, I can go and get through a plural site, through lynda.com or LinkedIn now, through work.
Trilogy, right? You've got all these dev boot camps online, changing trajectories of people's careers for exceptionally cheaper costs.
So, I mean, there are mechanics right now that don't have anything to do with whether U Chicago or YU should be charging hundreds of thousands of dollars to confer a degree, but there's obviously more value beyond the content, which is transferred online. And if that's lost, and this again is a short-term challenge, we're accommodating and bending because of health restrictions. It's not that YU or Chicago have declared everyone must go online now. This is the only way to do this. I think we have to be cautious to separate what is a near-term challenge, and therefore everyone's scrambling to provide, and it could be a subpar experience online, but it's short-lived, hopefully, and what is a overpricing of the thing you're purchasing, and therefore we need to switch out pricing across the game.
Here's the thing I'll ask you, and you're in the content business, right? I mean, among other parts of what you do. If you're in the content business, you want the largest number of people to engage in your content. And the greater the scale, the better the unit economics are, both for the purchaser and ultimately for the seller. So in my mind, scale is the way. In other words, I don't see why to pick up, what Harris was talking about. Southern New Hampshire is a client of what we do. There's no reason they couldn't do what they did instead of for 130,000 students, for 1.3 million students. And I guess my question is, do you think that we're going to see structural changes like that? Do you think we're going to see people who are saying, I'm going to have better unit economics, and I'm therefore going to be able to spend and buy the best content that there is, and I can provide many more things because I've got that unit economics that no one else is going to have? And that, to me, that's the lesson I learned in the entertainment business. And I don't see any of you jumping on that.
Because keeping in mind that has a ratio no matter what. You have a X instructor, unless what you're saying is completely asynchronous. So it's self-propelled, self-powered education. If you have a traditional classroom model where you have one instructor, several TAs in college, or going back to K-12, if you're going to have a classroom of 150 to one teacher and several assistants, it's a very different dynamic of learning than what the traditional sought after 130,000 student class is still getting. Remember, they are still powering, SNU is still powering those classes with a small enough ratio that the teacher to student ratio isn't.
Or you go MOOC, Judah, right? Or you're thinking about a MOOC, but then Seth, I would say what led to the downfall, or you could argue, was it a downfall of MOOCs, massive open online, courses, which is what you're trying to drive at, that is the scale model. But then I think people look at the graduation rates. You could argue that was or wasn't successful based upon the number of people that graduated from courses or successfully mastered skills. But by and large, most of these classes had dropout rates of, high 90%.
So why do you think that is? Why didn't MOOCs succeed as well as they should have?
Because you didn't have to pay for it. If you weren't really, putting out any money for it, so people kind of saw that was the value. And that was the point I was going to get to. I think Southern New Hampshire can get to 1.3 million students today. They'd have to bring down the price point. And in education, especially higher education, low price is kind of equated with low quality.
Yeah, and can you, though, Jeff, can you maintain a high quality experience with 1.3 million students?
See, I'm going to bring something up in this particular thing for all of you to think about. See, the paradigm when I'm probably the oldest one here, but we're all in the sort of maybe the same generation. When we grew up, quality was associated with small scale, right? You wanted the best thing in the world that was handmade, whether it was a motor or a small batch of whiskey or artisanal breads and things like that. What the internet has taught us is that quality now comes from scale. Google search is the best not because better algorithms, but because they have 4 billion searches a day and they have feedback loops. Amazon's shopping experience is helped because they know a lot more about who you are than even you think who you are, because they know so much about other people. And so what we've learned from the machine learning and the feedback is that quality can come from scale. And so I would say that
Yet McDonald's is scale and is the antithesis of quality.
that's not a feedback. That's not a feedback situation.
Well, Seth, when you talk about scale and advertising, the point there is you need scale to support the revenue model, which is advertising. And this goes back to the question that you asked previously: are there other revenue models and other folks who can pay for it? Advertising to date has not played a significant part in the academic experience for obvious reasons. And so therefore, like, you don't have the same incentive to drive scale, because that's not how you're monetizing. In a lot of ways, you're monetizing through exclusivity and the reverse of scale. Like University of Chicago, if it went to 1.3 million, it wouldn't be charging 57,000. It's able to charge 57,000. And by the way, that's just the nominal tuition. It's not the effective tuition. But they're juggling between the desire to maintain exclusivity and limit the number of degrees that they're granting, versus others who aren't focused on exclusivity. They're focused on accessibility. And I would say there's no, it's not binary. There's not one answer. There's not one right model, but it's up to the campus-based institutions. You can't assume that in this new world where people are much more familiar with online, that the institutions that want to maintain a sound campus-based model just stay static. They're going to have to change to continue to drive a very strong value proposition to enable them to stay in business.
Let me switch topics for a little bit, which is, there's some big public companies that appear to be very interested in education. A generation ago, Apple seeded a lot of computers in schools with the idea. They had an idea like the Jesuits, right? If you get them in the early years, you get them forever, right? Get people interested in Apple products, they use it forever. But now you see, like, Amazon has said they're going to spend $750 million just to retain their own workers. Google's got a big focus on the classroom, and Microsoft and Apple seem to be very conscious about education. Is this real business? Is it good works? Like, what's the motivation of these biggest of companies to talk about and seemingly participate in the education markets?
Maybe I'll start with this. So, 2 months ago, we were at the tightest labor market in, I think, about 50 years, at about 3.5% unemployment. And everybody was talking about the war for talent. And, one of the ways to not only attract, but more importantly, retain people were by offering benefits. And one of the biggest benefits you could provide is providing training, providing that lifelong learning, that somebody's going to come to your company and they're going to learn and get skills. And even if they leave that company, they're going to take that with them. Hopefully that will continue once we get through this. But, I think this war for talent really accelerated companies to make those kind of decisions.
So that's over?
No, like I said, we're in 20% unemployment now. I think the smarter companies are going to say, all right, this is happening. We're going to get through this. But, maybe we'll take an opportunity to differentiate ourselves by still providing those benefits. They may make it a little bit more difficult. They may not put as much money into these programs. But I think some of that momentum, unfortunately, might be lost.
Aren't companies like Apple and Google and Amazon primed to deliver educational content? Wouldn't you imagine that they have the sort of the bones right now to do that at scale?
So where we see those large players playing in the education space, and they've had missteps. So if you look at acquisition strategy of some of these players, instead of buy versus build, you have like 10marks, which was a math company, a little bit ELA, acquired by Amazon and actually sunset and shut down a little over a year ago because it was a failure. It wasn't deemed scalable enough. It didn't penetrate into a big enough market for them. Where we see all these big players like Google, Microsoft, Amazon playing is on the cloud consumption side. So they're going after cloud generating revenue, which is the data, the underpinning data that's being generated by all the Edtech learning management systems, schools hosting student information systems. That's my thought on it, is that they're getting involved here, but not so low down level necessarily in the content creation, the curriculum design, where it's messy, where you're battling out school campus for school campus on the sales side. They're going a level or two above that and saying, we're just going to get the whole state's data systems on our cloud infrastructure and let the edtechs fight it. And in fact, we'll sell to the edtechs the data consumption too, through AWS and through Azure.
It's mercenary. In other words, it's just, they wouldn't mind if it's an education company or somebody selling spinach.
Seth, a successful K-12 supplemental curriculum company is doing 100 million in revenue. Like, that's a super successful company that could, sell for $1 billion. That would be a massive success. It's a rounding error for these, for the companies that you're mentioning. That's not their play. Like, if they can dominate fulfillment, or they can dominate, curriculum management or cloud, then that's relevant. But we don't see them, building education specific products, maybe tweaking some products that they have for the market, but they're not, building specific products or, really aggressive acquirers of these companies, just because it's a matter of scale.
And they cannot leverage the data. It's entirely unacceptable to make use of data, even for adult students. It's still very much a new.
But what percentage? 60%, 70% of kids coming out of high school, have Google accounts and are familiar with Google tools, and are expecting to have Google in their life in college and in the workforce. So it's a loss leader.
It is definitely a retention of their base. They hope people convert from school-based Google accounts to personal-based Google accounts.
As I said, the Jesuit strategy. Give me a kid for the first 6 years of his life, or maybe that's the Cheder strategy.
Indoctrination and inculcation.
Jeff, how are the public capital markets doing amidst all the gore that we're seeing? How are the education-related companies doing in this? Are they faring better, faring worse?
So this has been fascinating. Let's turn back the clock 2 months ago or so, when this crisis just started. Any stock of any company that had the words online and education in their description skyrocketed. I cover a company called K-12, LRN is the ticker. They manage virtual charter schools for the most part. I'm not exaggerating. That stock was up 40%, I think, the first week or two in this crisis, when the market was moving in the other direction. After the first couple of weeks, investors started digging a little bit more into what these companies do, and realized that, if Yeshiva University has to move remotely, it's not that everybody's going to drop out and go to University of Phoenix or go to Strayer University. So in the near term, some of that euphoria died down when people started understanding what these companies actually do. They've started to come, we've gone through earnings season for many of these companies, and they've been explaining, where they are positioned now, but how they tend to position themselves going forward. And I think, we're at somewhat of an inflection point for online education in both higher ed and K-12. And I think many of these companies will benefit. You may not see that in their numbers this quarter, but I think, the experiences of a lot of students learning remotely has not been great. And we may migrate to some of the companies that have been doing it for a decade or so. And I think it'll be advantageous for them. And you're starting to see them come back accordingly.
Yeah, to your point, obviously, Jeff, LRN spiked, lost quite a bit, and is now within $2 of where it's at least 6-month high was. Chegg, a lot of the services businesses, tutoring businesses, are doing amazingly, and rightfully so, because unless folks abandon education, the supports need to step up for what doesn't happen in the academic assistance centers and the services that you would get on campus. Third parties now have to kind of fill that gap, and anytime there's a vacuum, they're going to jump in there. So Chegg had a reported fantastic first quarter for this fiscal, and the expectation is, even with the significant declines in enrollment, even if colleges that were on the precipice of imploding pre-COVID don't open, they'll still be just fine, because mom and dad, for the younger set, and Johnny all the way through the end of his learning career still need some level of third-party support to get through it.
But let me ask
Yeah.
a question from all of you, and then I think we'll also look to see if the audience has questions for you. So right now, I think we talked about the largest universities in the United States. I think it would be like ASU, WGU, and Southern New Hampshire are sort of topping 100,000 students. And then it drops down significantly, right? The large state universities are sub 50,000 and then goes down from there. What do you think the largest university will be in 10 years in the United States? I mean, everyone, just give me a guess. We'll get back together in 10 years and we'll see who's right.
I think you could see a university with 1 million students. It'll be almost exclusively online, but I think that's very possible, especially, you know, if they attract global students.
John?
I agree with that, but I would also say I think the mix of what they're offering is going to change, and the definition of what the credential is that you graduate with will change and expand dramatically, and I think that'll help to drive the scale too. It's not just going to be a 4-year degree or even a 2-year degree.
Harris?
I was going to say, I think there's going to be a consolidation, and I think people are going to rethink the value of brands of the universities. And so I think where people will struggle is the colleges and universities that haven't thought about their unique value, like a community college focusing on technical skill set, but they've just been there. They're the Eastern Bumbleville of South University, and people just go there because they want to check the box. I think those will struggle. I think those that have great next steps in terms of career pathways and upskilling will be very successful. And I think you'll continue to see strength. You're not going to unseat the Harvards of the world. They have so much strength in their brand and recognition over so many years. To eliminate and disrupt that, I mean, Harvard's endowment is $20 billion. They're not going to let that go away tomorrow. So they'll fight for that, and they know how to. I think one of the biggest shifts you'll see, though, is the move from where you see consumer products focus, like Chegg, where they understand that they're fighting in a consumer-driven market, so there's a need. Universities, by and large, have not really focused themselves as a need, but more of a want. I want to go to college. I don't necessarily need to. And now, with the push to online and with the push of the competition happening here, I think more both EdTech vendors and the universities and schooling programs are focusing more on how to deliver on a need, not on a want. And there's a big difference in how you develop for that.
We have some questions from the audience, and I'll think, so from Sheldon Friedman to all of the panelists, any thoughts on fatigue that we're hearing about with online settings now, and desire to take a break away from all of this until a healthier hybrid system is created?
So there are a lot of universities that are already signaling that if they can't open in some way, shape, or form, may not open for the fall. I think, all the way from the most anemic doomsday projections, even to the most conservative or positive ones, enrollment's expected to be affected by this. I think it's partly because of what we were talking about before, Seth, and Sheldon, thanks for the question. I think it's because we don't have, for the brick and mortar schools, a particularly well-oiled, streamlined way of delivering the education, and it was thrown upon them in the middle of a semester. I think if this were a longer-term need or a longer-term issue that had to be solved, education remotely would get better, and it's still going to be the case that it's not for everyone. Not everyone can kind of learn in that ecosystem and may need to kind of bow out until things do get better.
As someone who had an empty nest until about 60 days ago, and now it's filled, I hear you. Another question from the audience from Jacob Weisschlotz. Are you familiar with U of People Shai Reshef, online global university serving world markets, including underdeveloped world? Anyone?
Yes.
So, I think you're supposed to expand on that. Is it a true or false question?
Yeah.
What do they do exactly?
It's a nonprofit accredited. It's tuition free, so it's kind of a mix of MOOC meets an attempt at traditional school without any of the kind of the rigor or the gravitas generally afforded to you by a real institution.
Let me ask a couple of questions two questions closer to the Jewish world, the world around Yeshiva University. So the first one is that, Josh, you ran a Edtech conference that was in Israel. I know I went there for a number of years. Israel seems to have a special feel for Edtech startups. Is it just startups, or is there something about education that's close to Israel's values? Why did you choose to put your conference there?
So A, love of Israel, B, desire to expand our focus on education to a country where we want to do business. But C, a hypothesis that, EdTech is something that Israel really should be good at, just like it's, a world leader in cyber tech and water technologies and automated driving. The IDF is one of the most effective education institutions in the world. It takes 18-year-olds and and rapidly assesses them, introduces skills and makes them successful in operating in incredibly stressful, intense environments. So our view was the great technology capabilities plus coming from a culture where human capital is so important, are the right recipes for EdTech. And so we launched a conference when we realized that interest in EdTech in Israel was lagging, and it needed a catalyst, and that was in 2016. And in over the last several years, we just see the ecosystem is expanding in an incredible way, and there are great startups coming out of Israel right now.
And closer to home, I assume the panelists, everyone has had a kid in a day school or yeshiva and things like that. What's the impact of COVID on those day schools, which I know a lot of them were already strained? But what's going to happen? What's going to happen in that world in the next few years if there is 20% unemployment and the like? And Lawrence, feel free to jump. I know you're very involved in this.
I'd like to hear from the experts first.
Well, I'll tell you anecdotally. So my kids are older, but just in talking to some folks in our neighborhood, people are really rethinking: is it worth spending, $15,000 to $20,000 more a year for a day school if we're just going to be online again in the fall? I've talked to a number of parents that are thinking of starting their kids in public school if their day school is just going to be online. It's going to be interesting.
Yeah, maybe I will chime in. I'm on the board of Yeshiva College. My wife's on the board of SAR. So we definitely hear a lot of feedback from parents about what's going on. We obviously hear a lot about the schools of what's going on. Yeshiva College had a board meeting yesterday, and I won't get into tales out of school, but I will share that the school did a broad poll of the undergraduates and the graduate schools. And I think about 1,000 people responded out of 4,600 or so, that total population of all of those institutions. And interesting macro feedback comparing the graduate students versus the undergraduate students. And when you take a look at the results, it seems very logical in a way, where the graduate students who are in more vocational schools, I think the social work schools, psychiatry, the various schools, education that the Yeshiva University has, they actually really enjoy the online format. They're there for the content. They're not there for the environmental, social dynamics that students really go to the undergraduates much more. They enjoy the time, the flexibility. They're at home, they're older, the graduate students. So having some flexibility with the kids seems to work. So the dynamic of content in an online world seems to work for graduate schools much more than the undergraduates. When you get to the K to 12, I think it's even more dramatic, where it's very difficult for why people are paying for the school is that social dynamic, that the kids learn socialization skills. They're in there. It's difficult for parents to operate with lots of little kids running around. So I think there's going to be tremendous pressure much more for the K-12 schools, the SARs and the various Yeshiva day schools, to do whatever they can to be open in whatever form they can be open, perhaps with some supplemental items on an online world. And I think the graduate school worlds might have a much easier time migrating and using this COVID dynamic to almost segue into a different kind of format. So I'll offer that feedback, at least what I'm seeing on the ground, as opposed to what people are actually working in the field all day might see of it.
Does that mean we should go long to you?
No advice given.
You're not one of my clients, so I can't say anything.
There you go.
I could trick you into.
Well, listen,
We're running short on time, but I think.
yeah, let me throw something else out. This is a macro appeal, and I will leave it for people who want to ask any last questions or comments to type them in. But as a general matter, why YU does this is that we're our university. Our goal is to constantly educate. So that's why we do the forums in person. We're doing them online. We are about content. We're also about the networking. It is called the YU Professional Network. So having the people be there, we don't want to lose that. We're going to have to figure out how we do the networking better online. I'm sure there are some ways, but we want to continue to have this content available. So we really want to thank the 5 of you so much for your insights. I also want to ask you and all the attendees who are still online over here, a key component of why we do it is to help the students. It's not just the networking amongst ourselves and the learning amongst ourselves. The students this year are having the toughest time with summer internships, as you would imagine. If anybody has some time, even if it's just for a half hour or 20 minutes of a mentorship call, ideally, any internships will be so welcome. We're going to send out an email to everybody. It's an MVP program that the university have. We would really appreciate it, as we're getting so many students who have had their summer internships pulled from them because of this dynamic. And you might be in a similar situation, but if people can help, we would really appreciate it. And again, if people have other feedback about this forum and format or time of day, we've been working with this Wednesday 1 o'clock to be flexible from California to Israel and everywhere in between. If people have some other thoughts about that, please let us know. I don't know if anyone on the panel has any final comments, but really want to thank all of you so much for a very interesting discussion, a very timely discussion.
I just thought our panelists were fantastic, and if this were live, I'd ask the audience to give them a round of applause, because really thought-provoking and diverse answers. So this was great. I enjoyed this a lot, and thank you all very much for making the time.
Thank you so much.
Thank you, guys. We can still applaud.
Thank you, guys.
Also the applause. Thanks, everyone. Have a great
Thank
day
you.
and stay safe.
You guys too.
Bye, everyone.
Bye-bye, everyone.
Thank you.
Thanks.